This global bond market is starting to feel like it's feeding on itself in the last couple of days. What's driving it for you?
I think it's just logical given our long-term view of slow growth and low inflation over the horizon, volatility picking up, and maybe the stock market had gotten a little bit ahead of itself. So where the bond market is going, people are saying we want safe assets, and especially in the U.S. Treasury, U.S. agency mortgage-backed securities yielding 2.5% to 3%. It's a safe asset that protects you in a downturn if the trade war turns bad or if growth slows down. So people are looking for that safety as well as the return generation that bonds give you.
Erin, this is an idea that you guys have been pushing, the idea that US duration is the best place to be as a hedge at the moment compared to the bond markets elsewhere. Why?
Well, if you look across the globe, you look at the U.S. vis-a-vis the rest of the world, you have the U.S., which is still offering a real yield versus Germany versus, a 10 trillion nearly in negative yielding assets. So on a comparative basis, the U.S. looks a lot more attractive relative to the rest of the world. And that's why you continue to see inflows into the U.S. bond market. And that continues to keep a duration bid out there in the market.
It's a theme that's come up on this program already this hour, the positive real yield on treasuries. Is it inevitable now that that's going to slowly get eaten away at down to zero in the next year or so? Is that something you anticipate?
Not down to zero over the next year, but certainly over the secular horizon, which we define as the next 3 to 5 years, we do see definitely an opportunity for that real yield to be eroded away and to move back down towards the zero bound. So probably not here right now, but certainly over the next couple of years, we do expect that to occur.
Something that's come up in this secular outlook, and I think it's been in the work of Pimco for the last 12 months or so, Mihir, is just how incrementally defensive the firm is becoming. What's driving that? What's at the top of the list that's driving that right now?
There's really 2 or 3 things driving that defensiveness. One is just valuations. It's hard to see any asset class that is going to generate great returns for you. So given valuations, given liquidity in the markets, both in the equity market and particularly in the bond market, and then seeing volatility go up as well. So we're not expecting a recession anytime soon, but we want to get more liquid, we want to get more cautious, and we want to go up the quality spectrum. What this allows us to do is earn returns for our clients while waiting for those air pockets or the periods of volatility when we can be offensive when others are being defensive. So we're not expecting a big downturn anytime soon, but we think all the signs are there that tell you that this is not a time to be taking outsized risks.
So this is how you were set up, Erin, going into December. And then I believe you deployed some of that dry powder in December. Walk me through how that's built up as the year has progressed. What have you actually been doing?
Yeah, so firstly, I think it's really important in an environment where we think volatility is picking up to stay very tactical. And so unlike what we saw over the last 10 years, where the Sharpe ratio of the S&P 500 was on average over 1, we're getting into an environment where we think returns are going to be lower and volatility is going to be higher. So you have to be nimble in terms of how you're trading. Secondarily, over the last, coming out of December, we started to get a lot more optimistic, thinking that a lot of the negativity was priced in. So we're really trading the cyclical outlook on global growth. We started to buy equity risk, we started to buy high yield risk, we started to sell duration. We've reversed course as we started to see that data rolling over at the end of the first quarter and have now become much more defensive in terms of our positioning. And as Mihir mentioned, we want to stay large, liquid, and stay diversified in our portfolios. And along those lines, we've started to unwind some of the cyclical risk and beta exposure that we took earlier in the year.
Is that across the globe? Is it more regional specific? How does that work?
No, it's across the globe. In terms of quality, in terms of defensiveness and liquidity, we prefer U.S. assets. We've talked about the bond market a lot, but even the equity market, the up in quality theme means in your return-seeking assets, whether it's stocks or bonds, you want to be in companies that have high and stable profitability and low leverage. So that means the U.S. So while we've taken overall exposure down, it's been more overseas than the U.S. The U.S., both the stock and the bond markets, are probably the safest and most attractive markets right now.
What's both interesting and refreshing is that trade has hardly come up in this conversation when you're thinking about allocating capital. How has it come up in conversations behind closed doors here at Pimco? How are you thinking about it at the moment, Erin?
So we are very focused on the trade wars, the trade tariffs, and as Joachim had mentioned earlier, we do think that this is going to be a persistent risk over the secular horizon that's going to be front and center for markets. So while certainly we could see some alleviation of that risk over the next couple of months, we don't think that that's going to go away. It's going to be a slow burn in the background. And certainly in terms of how we're positioned in terms of our portfolios, one of the reasons that we became more cautious earlier this year is because we started to see those trade tensions flaring up. And we do think that that is certainly over the next month or so, we don't see that ebbing in terms of the risks out there ahead of the G20.
Does it shape where you buy and not just what you buy?
Absolutely, it does. We were earlier in the year much more optimistic on emerging market risk, on Chinese risk specifically, and we have sold out of those positions. And so it certainly does shape not only how beta on we are in terms of our portfolios, but where we're choosing to take that risk.
Because I have to say, Mihir, in the piece itself that we unveiled this morning on this show, EM, you didn't sound too bearish on emerging markets whatsoever, as far as I could tell. Give me a little bit more clarity there.
I think there's lots of the valuation-wise, we know that long-term EM is where the growth is. Valuations are cheap as well. So you can pick and choose your spots and your areas and regions in the emerging markets that are growing, that have the right political and financial changes that generate high returns. But as a whole, when trade is at risk, when China is in play, you want to be a little bit cautious on emerging markets right now. But longer term, there's no doubt that you can find opportunities of growth and high returns in the emerging markets.
Final word on what's happening in the bond market at the moment, Erin. How many people are asking you about the yield curve inversion? How often does that come up in conversations right now?
You know, I think less now as people have started to get more comfortable with the fact that a yield curve inversion doesn't mean that we're going into a recession tomorrow, but certainly it is in the back of the mind as a fear, as a concern for investors. And I think as the curve becomes more inverted, I do think that you're going to see more talk about that pick up.